Today is we're primarily going to look at the solution to the economic statement conversion assignment. The feedback was that a lot of people struggled with this, particularly on the CFI, and because it's so core to what we're going to do, I want to kind of go through the solution in class. Okay, so we're going to spend most of our time today going through homework, last homework assignment. However, it's important prep because in our next class we're going to get into economic statement analysis. So if you don't understand the statements that we've converted, you're going to get more lost when you try and figure out how to analyze all the data that's coming out of the statements. And by the way, that's actually what's going to be core to your upcoming exam in a couple weeks, because your first midterm exam is primarily convert and analyze the statements. That's the entire midterm. Okay? And then after the midterm, we're going to get into valuation, but we're going to start with the converted statements to do the valuation and the forecast. So all roads from this point start with these statements. This is kind of a core underlying principle for a lot of what we're going to be building through for the rest of the semester. So that's why I really want to make sure we understand not only how to do it, but what this information is telling us as we go through and set up these statements. So let's start out today by talking about our last homework assignment. Right? So again, you're going to be given financial statements. In this class, I am giving you statements that are labeled. In the real world, that will not be the case. Like if you're looking at a 10Q, 10K, even Bloomberg, everything is not necessarily labeled. So I'm giving you a benefit now. Right? Prior to we get to the real world for this assignment, the midterm, I'll keep giving you the labels, but eventually you have to kind of like learn what these terms are yourself so that you can actually define what category a statement should fall in. But we're going to start the process of mapping to Modigliani-Miller, operating ones, non-operating twos, debt threes, equity fours, and we're going to put together our four statements. It doesn't matter whether we start with the income statement or balance sheet. You have to do both of those statements to get to the statement of cash flow. So those statements can be done independent of each other, but we're going to have to convert them both. I'm going to just start out with the balance sheet only because it was probably easier for you to convert. We'll go by level of difficulty. This should have been the easiest of the statements to actually convert with. So we'll start out with that. The converted statement is called Total Funds Invested, TFI. Make a new tab. Relative references for the years. So blow it up a little bit, make it easier to see. Copy and paste. And the first step is start putting for the operating, all of the operating assets and all of the operating liabilities together to be netted. Okay, so we'll start out with anything that is labeled as a 1 that is an asset for the balance sheet. Start out with operating cash. And then we have receivables going down through goodwill. And then we look for any liabilities, accounts payable, other current liabilities, and final one would be other long-term operating liabilities. So these are the operating assets and liabilities. And we said to get to operating invested capital, we take our assets and we net those out against the liabilities. And that would get us something called our operating invested capital. Okay. So two things. One, Legos, don't leave any ones on the floor. So make sure you copied all the ones. You count for every category. Easy to make mistakes. And then two, make sure you're netting the assets and the liabilities. Okay, so assets minus liabilities. The net of that is what we're calling operating invested capital. And just very important language, this is different than what other people call invested capital because that includes non-operating items. So in this class, if we use the word invested capital, because we'll be lazy and I'll just say invested capital, I'm referring to operating invested capital unless I say otherwise. Okay? Whereas other people say invested capital, they may not be talking about operating invested capital as we're defining. So in this class, invested capital and operating invested capital are essentially synonymous because we're talking about the operating part. It's important to distinguish for clarity if we ever are talking about something else, right? But the idea is this is what we're investing to support our continued operations of selling products and services as part of our normal course of business. So it should lead to future revenue, okay? Now, I didn't ask you to do this on this assignment, so this is a solution for the invested capital, but I want to show you what we're going to do with this later to get to forecasting, which is right now we have operating invested capital, but eventually we want to break out working capital versus longer term capital, okay? So what I'm going to do is start rearranging this, put in some extra rows here. Working capital is current assets minus current liabilities. Therefore, operating working capital, as we define it, are the operating current assets minus the operating current liabilities. And that will get us something called operating working capital. Again, different than the accountant definition of all current assets minus all current liabilities. So therefore, it is the operating assets that are current minus the liabilities that are current, not interest-bearing debt. So anything interest-bearing is a 3. We took that out. But nonetheless, we will add that, add a row in here just so it's easier to see the sections, to our long-term invested capital, spelled today, capital, which is the assets that are long-term minus the liabilities. And then when we add the two together, we get operating invested capital. Right? So we get the same answer, but the difference is eventually when we forecast things, we want to be able to forecast a little bit more granularly, right? Because the problem with forecasting what I call blob, which is when you just mix everything together, is you forecast it all to grow at the same rate. Well, if you think about it, how fast inventory grows versus how fast a plant grows, they're probably not going to grow at the same rate. Okay, I add plants in steps. I add inventory kind of more marginally. So I might want to forecast working capital to grow at a different rate than my long-term capital. So when we get to the valuation part of the class, I'm setting the statement up this way so we can forecast it separately, okay, and analyze it separately. But for purposes of the conversion, they're going to be mixed together to get our invested capital, okay? So right now, if you just got to invested capital, that's okay. But eventually we're going to start putting it into kind of a current and a longer term format. So I'm just showing you that rearrangement now. Questions about what I just did? Okay, continuing on. We're going to do the same thing for the non-operating assets. We look for anything that's non-operating. Excess cash, equity investments, anything that's a liability, other long-term non-operating liabilities. We basically, again, have our non-operating capital, which are the assets minus the liabilities. And we add the two together. We get our total funds invested, or TFI, which is the operating plus the non-operating. And that is the total investment in our business. Okay? So what we've cleanly established is we have, in the first year, $37.25 invested, $32.60 in our operations, $4.65 in other stuff that has nothing to do with our operations. Okay? Now we're going to go to the other side of the statement, which is the financing or the funding side. So basically, this is what was invested. It's got a balance. Where did the money come from? How did we finance the business long term? So the first one is our debt, our threes. Anything that's interest bearing for long term financing. So in this case, short term debt is a 3, long term debt is a 3, and those are our threes. Now, again, important nuance of our approach. In a traditional accounting world, they will say that short term debt is part of current liabilities and therefore part of working capital. In our world of Bigliotti Miller, no, it's not. That financing is not part of working capital. So therefore, we're taking short-term debt out of working capital and we're putting it into the financing section because it's an interest-bearing debt. Okay, so that's what I said. You got to be careful about what the rest of the world is doing with their statements because we are reorganizing them in this more consistent approach. Okay, so that's the short, long-term debt. Those were our only threes to finance the business. And then the rest of it is fours, which is our equity financing. So anywhere from minority interest all the way down to treasury stock. So when I sum these up, the financing should equal the investments. Okay. All right. So long story short, this is the balancing statement. Now, there are two categories on the statement that you may not be familiar from the accounting world, and to some degree, it doesn't matter. Like when you're doing the statement, I could just say 1, 2, 3s, and 4s, not even tell you anything else about their names, and you should be able to still rearrange and balance everything. All right, just by putting all the ones together. As long as you knew they were an asset or a liability, you could know whether to add it or subtract it. Okay, so you didn't have to know what the terms were to balance the statement, but two terms on here may be unfamiliar to you. One is called minority interest, and the other is called treasury stock. So let's make sure we all understand what those are. All right, so does anybody know where minority interest comes from, or what that is? Okay, yes. Yes, so it has to do with control. So under accounting rules, if you own something but don't control it, right, then it's a minority interest, right? But if you own something but not all of it and control it, then what you do is you consolidate it as if you owned 100%. So 50% is the rule. So if I own 50% or more or control 50% or more of something, I treat it as if I own the whole thing. I add it all together. But if I own less than 50%, I don't have control over it. So I treat it as a minority stake in another firm. So for example, if somebody mentioned SoftBank, SoftBank owns 30% of WeWork in the last class. So therefore for them, they don't control WeWork by the day. So from SoftBank's perspective, it's an equity investment in another company. They just get 30% of the profits and somebody else runs the business. Okay. Now, if SoftBank owns 60% of WeWork, then they treat it as if they owned 100% of WeWork. Okay, but they didn't do that. This is the minority interest. Okay. Now, the other category is called treasury stock. Treasury stock occurs when when a company repurchases its own shares. Right. So when you issue the shares, common stock at par value, and additional paid-in capital. It's book value. But when you repurchase your own shares, you repurchase them at a market price, at a market value. So when a company buys back its stock, it goes out of circulation. So it doesn't cancel the stock and it becomes non-voting, but basically the company buys back the stock at the market price. So the market price it bought the stock back is called the treasury stock, which is a contra account to equity. Right? So you got the book value which was issued, the market value purchased back treasury, the net is your equity account. So what you can see is because it's a market value, some companies can actually have negative equity pretty quickly by buying back some of their stock, but not all of it. Okay? But nonetheless, an increase in treasury stock, more contra negative, means a repurchase has happened. More stock was repurchased. Cash given to shareholders. Okay? All right. So that was statement number 1. Questions by this? Yes.
I don't know, where would this be on like the balance sheet or if there's like stock compensation
Well, increasingly, the SEC is kind of mandating, and the accounts are going along with this, that stock compensation is becoming an income statement item. You have to expense it. Okay? So, but nonetheless, those are things that we have to keep track of, right? And the statements get far more complicated. All right, good question. Other questions? All right, so statement number 2, TII. Total income available to investors. This is the reorganized income statement. So in a way, similar process. We're going to do it for the 3 years. And by the way, I can give you on another assignment 6 years, and it shouldn't take you any longer to do the statement. So the number of years doesn't complicate things as long as you're using relative reference as you're cutting and pasting. My only reason for doing that is just intimidation because it looks scary, right? But I can give you 10 years on the midterm and it wouldn't change how long it takes you to do the midterm, as long as you're using these relative references, okay? But nonetheless, 3 years. So the first part, again, 4 sections. Start out with the operating, the ones. The first of the operating items in the income statement is our EBIT to get to our NOPLAT. And EBIT for the 3 years was this number. Now, word of warning, technically this is supposed to be operating, and we're making an assumption that EBIT is operating, right? So interchangeable words, EBIT, operating income, operating profit. However, EBIT could potentially include non-operating items because EBIT is just earnings before interest and tax. And if the accountants jam in a non-operating item above EBIT, we would have to take it out. Now, for this assignment, for your midterm, before the exams, I'm not going to do that to you. I'm not going to try and throw a curveball at you and put in a non-operating item above EBIT so you can use this method. But when we get to the real world, I can't tell you that the accountants aren't going to do that. So we're going to be very careful that technically what we really want is operating income. Right? But hopefully, in our case, they're the same thing. This would then be the tax we would pay on the operating EBIT, operating income, which is... Gave you a tax rate of, I believe, 30% as an assumption down here. So what I'm going to do is take that times the 30%. And that will give us our NOPAT or our NOPLAT. But this is how much profit we make from operations on our income statement. And those will be their operating taxes and the operating income. Okay. Now section 2 is non-operating. So if we go back to our financials, we had 2 2s on the income statement. We had interest income, and we had non-operating income, non-operating gains and losses. So let's put those on here real quick. Now, you could add the 2 together and net them, and that would actually get you a correct answer. But just so you understand what's happening more granularly, I'm going to do these separately. So, if I have this level of interest income, I'd have my tax on my interest income, which is multiplied by 30%. And then I would have my after-tax interest income. I do the same thing with non-operating income. I have my non-operating income. I have my tax on my non-operating income or profit at 30%. After tax, non-operating income. Now, it gets a little tricky when we lose money. So in the 3rd year, we actually had a negative amount of non-operating income, suggesting that we lost money. Now, generally, you get tax credits for losing money. You can go 2 years backwards, or up to usually 10 years, I think, forward, carry forwards or carrybacks. But the idea is that you'll get a refund against taxes paid if you lose money as a business. So the whole point is, I lost $5 million. I'll get $1.5 million back as a refund for the loss, to credit against the loss. or use it against future earnings. So therefore, my after-tax non-operating income is negative 3.5. But I want to put an asterisk by this. Let's say you're WeWork, and you conclude that WeWork will never make a profit. Okay, they're just too far gone. And they've never made a profit, they probably never will. Well, if you're trying to figure out cash flow, we can't give them a tax credit if they'll never actually make a profit, right? So just got to be careful because, yes, we're making a simplified rule of thumb that we're just going to deduct this and get tax shields and tax credits. But the companies that eventually got to pay taxes to get the tax credit. So if you really believe the company's never going to pay taxes, then zero. They just lost money. They'll never get the tax credit, right? So you got to be careful about this. Not saying it will ever happen, but it could. So again, we're eventually trying to get to a cash flow impact. All right. Now, as I said, you could have netted these together and then done the tax. I did this more gradually, but eventually we're going to get to the overall non-operating profit or non-operating income, which is the after-tax interest income, the non-operating income, and then we add these together. We get our total income available to investors, which is the 217 of no-plat, the 30.8 of the non-operating profit, which was 247.8 of total income available to my investors. We made this much from running our business. We made this much from other miscellaneous things. This is the total income that we had to distribute to our investors. Okay, so again, as we go to the other side of the statement, the financing side, basically the metaphor I want to use is we're just running a cash business, and every time we make money, we just put cash on the table, and every time we pay bills, we take cash off the table. Whatever cash is left on that table, our total income available to investors, is the cash that we're going to chop up and distribute to our owners. Okay, now when we're chopping up and distributing that money to our owners, statement's got a balance, so all the profits equals all of the payouts. Therefore, when we go to the other side of the statements, since the profit equals what we're paying out, payouts are positive numbers. All of the losses equals need for financing. Therefore, TIIs that are negative, losses, means financing negative on the funds flow side, the financing side, that needs to finance those losses. So inflows of money to the business are negative. That's how the second side of the statement is structured to work for both TII and CFI. So our first debt, which is the first part of the payouts, or threes, is the interest expense. Should this number, given my definition, be positive or negative? Is this money that's going to the debt holders or coming from the debt holders? It's going to the debt holders, therefore positive or negative? Positive numbers. So got to flip the sign. Then we will have a tax shield. Again, eventually got to pay taxes to have a tax shield, but at 30%, we would have our after-tax interest expense. If I can spell it correctly. Which is the interest expense minus the tax shield. So this is how much we're giving to the debt holders effectively. 37.8, 43.4, and 56. Okay. The final one we have is our fours, our equity cash flows. And we have two fours on the income statement, the minority interest and the net income. Now, you'll notice that there were four fours that I originally gave you. Two of them were dividends. Dividends are not on the income statement. So again, the income statement ends with net income. So if you tried to put the dividends on the income statement and rebalance it, it would never balance. Okay? So again, the reason I'm doing this is because when we do cash flow, we eventually need the dividends for the cash flow, and they come from the statement of GAAP cash flow. But nonetheless, they don't go on the TII. So minority interest and income, which goes back to should these be positive or negative numbers. So let's talk about minority interest. Your equity investment, your asset, where you have a passive investment in my company, is a liability from my company to you. I owe you for your minority stake. And that minority stake that I owe you for is called minority interest on my balance sheet. So your equity investment is my minority interest. So the controlling company that has somebody else that is invested in it, but they don't own all of it, they owe them something for that investment. So that investment is a liability to those shareholders for part of the profits of my business. So under consolidation rules, if I control a business but don't own 100%, I treat it as if I own 100% of that business. I take 100% of the sales, I take 100% of the costs, and 100% of the profits. I, as the controlling company, am responsible for paying the taxes on that total business. I pay the taxes, and then I say, okay, I've done this, but you own a piece of the earnings, not all of the earnings, just on the part that I've consolidated. Your piece of the earnings, the distribution of that cash dividend to you, is a minority interest payment on the income statement. So on the balance sheet, minority interest represents the financial stake that I owe you. On the income statement, the minority interest represents the cash payment that I have made to you for your minority stake in some but not all of my earnings. Because the rest of those earnings belong to my common shareholders, right? So you don't get access to the other earnings that I didn't consolidate, and my common shareholders don't get access to the part of the business that you own. So I break that out as a payment to the minority shareholders. So that's what's happening here on the income statement, and that's why you're going to see minority interest on the income statement and minority interest on the balance sheet. Okay? And just for fun, accountants label this other things sometimes, right? But nonetheless, generally minority interest. So using that definition, does anybody have questions about that definition, by the way? Does that make sense? Should that be positive 20 or negative 20? If this is a dividend distribution to the minority shareholder, positive 20 or negative 20? Positive 20. If I have 190 available to my shareholders, that's a positive number. Don't have to flip the sign. So if I add up these things, these three items, I should get a balancing TII. So again, structurally, I made this much money running my business. I made this much money doing other stuff that had nothing to do with running my business. I had this much total money to pay out. I gave this amount to the debt holders, and I gave this to the shareholders. Two sides balance, rearranged statement. Questions about TII? Just by show of hands, how many of you got the first two pretty much right? Great. So my guess is fewer of you got the last one right, the CFI, the big mistake. That was the one that probably caused you more trouble. So as I said, you don't have to do either one of these two statements first, but you have to do both of these statements to do the third. You can't do CFI until you do these two statements, because cash flow is income statement minus change in balance sheet. Okay, that's how we calculate cash flow. So therefore, we need an income statement and a balance sheet, a TII and a CFI, and the change of the TFIs to get a CFI. Okay, so statement number 3. After you do these two, you create statement number 3, which is called cash flow available to investors, or CFI. Make it a little bit bigger. Relative years. Now, because it's a change in the balance sheet, if I have 3 years worth of statements, I can only do 2 years worth of CFIs. If I gave you 5 years worth of statements, you can only do 4 CFIs, because you need a change in the balance sheet. So you need 2 balance sheets to do 1 CFI. 1 income statement's okay, but 2 balance sheets. Because conceptually, the income statement represents the change between those 2 balance sheets. So that's how we're getting cash flow. Okay? So anything change about those 2 balance sheets should flow through the income statement, plus other changes to those balance sheets That's basically what your CFI is, right? Again, 4 sections: operating, non-operating, debt cash flows, equity cash flows. So that process, income statement minus change of balance sheet, for each of those 4 sections. We'll start out with the operating one. The operating one is free cash flow. Starts out with cash for the income statement. So we go back to our TII. That was our no plat. But some of the no plat was calculated based on non-cash items called depreciation, because the government allows us to reduce the income by the non-cash depreciation expense to calculate taxes. But since it was a non-cash expense, we can add it back because it wasn't really a cash flow. So when we add no plat and depreciation, we get something called gross cash flow, which is the total cash profit from the income statement. So since we're adding back the depreciation, we'll flip the sign. And gross cash flow is no plat plus the depreciation. So that would be how much cash we're generating from our income statement for each of the 3 periods. Now the next step is to do gross investment. Okay, so for gross investment, I gave you a shortcut. And the shortcut was to take the change in operating invested capital plus the depreciation. So our change in invested capital was current year minus previous year. Our depreciation was the current year. And copy, paste. When you add the 2 together, that was the gross investment back into the operations of the business from a cash standpoint. And the operating free cash flow is the gross cash flow minus the gross investment. So this would be the free cash flow for the business for each of the 2 years. Okay, and that is a correct answer. Make sure I make a mistake. Go put my answer key. Should be a correct answer for CFI. Okay. All right. So back to this. Now, I'm going to break this down granularly. So I'm going to move this down because I told you we took a shortcut to get our change in operating invested capital. Yes?
For the free cash flow, would depreciation be pointless because we added in for the first part and then added in for the second part and then subtract one from the other?
It is, except for the fact that we're putting depreciation in gross cash flow. So because we're putting it into gross cash flow, we are basically netting it out here in the gross investment. So it cancels each other out. That's how the cash flow offsets. And you would say, why are we putting that there in the first place? Hold that thought for about 2 minutes.
Okay.
And I'm going to come back to how the accountants screw you and make life difficult just to charge fees. And that's going to be the answer to why. Okay, so back to this. So what we want to do is more granularly do this. So here's what I mean by granularly. I actually broke this out to be working capital and long-term capital. So specifically, let's do change in working capital. So my working capital went from, and I could have done this line by line, but I'm kind of cheating, from 810 to negative 767. So I disinvested in my working capital, which should basically be less investment. Okay. Now, I then need to look at my other 2s, change in PP&E, change in goodwill, change in other long-term non-operating liabilities. Change in PPE, change in goodwill, and change in other non-operating long-term liabilities. There's an acronym. And that is going to be my gross investment. But here's the thing. Change in PP&E is not the actual cash flow. The actual cash flow is called capital expenditures, or CapEx for short. So it's my CapEx. Okay? Now, when I went to Wharton and I took accounting, and I hated that class more than any other class, we did T accounts, and we put together these statements for the damn T accounts, and I just did a whole semester on T accounts. And all I know is what I learned about this is you had to use all those T accounts to create your statements. And so basically, this is the whole fundamental premise, which is you're taught that the income statement explains the changes between the two balance sheets. And so those are the three core statements that everybody looks at and analyzes. However, there's actually a fourth statement. What is the fourth statement that the accountants put out? See, most of us don't know the name of it. No, it's called the Statement and Changes of Equity or something like that. I don't even know because I don't look at it. Nobody looks at that statement because you don't need to look at that statement because the income statement is supposed to explain the changes in the balance sheet. Well, here's the thing. It doesn't. That the accountants have decided in this fourth statement to make changes to the balance sheet that don't flow through the income statement. And that becomes a challenge because when items are changed that don't flow through the income statement, then they don't actually explain changes in the balance sheets. And when they're pretty trivial, they don't matter. But I think because they generate fees, the accountants have learned that for money, they know how to bury bodies on this fourth statement because nobody's looking. And so you're going to get paid a lot of money when you go work for Ernst & Young and PricewaterhouseCoopers and all KPMG to basically figure out how to fool investors by putting stuff in a place where nobody looks. It's all smoke and mirrors. I'm not saying it's not legitimately put up there, but here's the point. The one account I hate more than anything else is called AOCI, Adjusted Other Comprehensive Income. It's a miscellaneous catch-all, which is an adjustment to the equity of the balance sheet that does not hit the income statement, right? Because what I was originally taught was you kill equity, that's a cost of doing business, and so therefore it should be an expense. But somehow the accountants have switched the rules to say, yes, but there's some things that hit equity that aren't really expenses. Well, I don't conceptually understand that, but they do that. They put it on this other statement. The other thing they do is with capital expenditures. The capital expenditures on the balance sheet are not the actual capital expenditures the company's spending because when an asset is end of life, it is netted against that capital expenditure. And so what they do is they say, well, here's how much capital we're doing, but here's how much capital was end of life, and they're going to eventually net those others, and that end of life stuff becomes another balance sheet adjustment that they make. So it's not the true CapEx of the business because it's being netted out against some of the other CapEx stuff that's done. So the problem is, because the CapEx doesn't actually explain the change in the net PP&E all the time. You look at the starting PP&E, you look at the net PP&E, add CapEx, subtract depreciation, you don't get to those two numbers. The difference is the adjustments that the accountants are making. And so I'm not saying they don't do this, but they become substantial enough that it used to be like $1 million, $2 million, who cares, rounding errors. Now it's like $100 million, $200 million, $300 million, $1 billion here, $1 billion there, AOCI. You're like, what the hell is this stuff, right? And so that's why what we're going to do is for CapEx, we're not going to actually listen to what the accountants tell us the CapEx is. We're going to solve for it, okay? Because that's going to allow us, because if we don't solve for it and we use their number, then we got to go digging around on this fourth statement that nobody truly understands what's on there to figure out the adjustments to make to our cash flow. So rather than digging through the fourth statement, what we're going to do is we're going to solve for CapEx. So how do I solve for CapEx? Well, I gave this to you as a formula. If you take your beginning PP&E, you add your capital expenditures, you subtract your depreciation, you get to your ending PP&E. Okay? So therefore, what is CapEx? Ending PP&E minus beginning PP&E plus depreciation equals ending PP&E minus beginning plus depreciation. Depreciation. Sorry, plus, there it is, depreciation. 20. We can test this. So, if I spend 20, I start with 2,400. I add 20, 2,420. I have depreciation of 220. 2,420 minus 220, 2,200. So what I'm saying is we're just going to solve for it, so that way we don't have to worry about the other statement adjustments. That has to be the capex of the firm. All right, just mathematically, it has to work that way. So we're going to solve for capex. Right? So with that in mind, that's our capex. Then, for both years, copy, paste. We're going to look at our change in goodwill. And here's another tricky thing. Where does goodwill come from? So if we went from 250 to 300, how did that happen? How did an extra 50 of goodwill show up? I'm sorry? We bought somebody, which means to buy somebody, we had to give them cash or cash in stock. So generally, there was some money that transferred to them to buy them. So an increase in goodwill suggests an acquisition, and typically it's paid for by cash, but not always. Fun part of this. But here's the thing. What happens if goodwill goes down? That's called an impairment or a write-off. Is there a cash impact to an impairment? No, there's not. Because when a goodwill is written off, it doesn't affect taxes. The only reason that goodwill needs to be written off is to justify fees. So there will be some of you that will make a ton of money figuring out how much to impair an asset every year. You'll write it down, and then nobody cares. Like, it doesn't affect anything. It's just a paper write-down. Okay? So what I'm saying is, from a cash flow standpoint, tricky. Increases in goodwill affect cash flow. Decreases in goodwill do not affect cash flow. So you've got to be careful. All right? For your statements before the midterm, I'm not going to give you a decrease in goodwill. But in the real world, we have to be careful about our CFI, because if a company is writing off goodwill substantially and we treat that as a cash flow, we will completely misunderstand how much is really being invested in the firm, because it'll look like there's this big negative disinvestment when it's just a paper write-down. So this is what I mean by there'll be rules we'll follow. We also have to understand what's happening by account. So change of goodwill. Increase, probably cash. Change in other non-operating long-term liabilities, yada, yada, equals they went from, where was it? 500 to 200. Okay. So, make sure I didn't forget anything. Change in, that was it. All right. So I was just cheating to make sure I didn't count. So let's think about the impact on the investment of this. All right. Do you guys pay rent? Okay. What happens if you don't pay your rent? Does it add to the cash you have available, or does it take away? In the short term. It actually kind of helps you in the short-term cash position if you don't pay your rent. So one way to not invest is basically to buy something and not pay somebody for it, increasing a liability. Okay, does that make sense? So if you're increasing a liability, what you're doing is you're reducing your investments. So flipping the sign. Because I'm basically spending money, but I IOU somebody else. I'm not really spending cash. I got the asset, but I owe them money later. So it actually is a short-term reduction in my investment. Let somebody else fund it. So I got to flip these signs. By the way, when I add these up, that is gross investment. So I told you this last week in the last class. I said, look, I did the shortcut and I did the granular method. You can do it either way, and I don't really care as long as you get it. Eventually, though, we're going to do the granular method for the same reason that we broke out the balance sheet. I will forecast a change in CapEx differently than I will forecast a change in working capital versus forecasting a change in goodwill. Right? Because I don't do acquisitions that often, so I don't want to forecast as doing them all the time. I don't do CapEx that often. I do it often, but not often, like every day. I do inventory more often. So I want to be able to eventually forecast those at a different rate. Hence why I'm breaking them out here. Right? Technically, when I convert them, I could leave them all together, but that's why I'm breaking this out, because I'm setting up our ability to forecast them at a different rate and get a better understanding of what's happening in the business. But regardless, this is how we get to our gross investment. And this goes back to the question about depreciation. So the problem with depreciation is there's a depreciation component to CapEx. There's a depreciation component here. They cancel each other out, but nonetheless, that is the change in invested capital plus the depreciation to get to gross investment. So that is the gross investment of the firm, the negative 273 and the negative and the positive 868. But that's where the plus depreciation shows up over there. So I can offset the depreciation from the gross cash flow. But I can't just ignore it because I need the depreciation to calculate taxes. So if the government ever changed the rules that said depreciation was non-tax deductible, I wouldn't have to worry about this nonsense. But because they do have to use the non-cash items to affect my tax basis, then I have to subtract this to get to the cash flow. Or subtract the net. All right, long story short, non-operating. Section 2. Look at the income statement, TII. What was my non-operating income? Well, it's two things. After-tax interest income, after-tax non-operating income, but I had netted them here after tax, so I'll cheat and I'll use that number. Then I look at my balance sheet. I had 3 long-term twos, excess cash, equity investment, other long-term non-operating liabilities. Actually, this is supposed to be other long-term. Did this wrong. This one was the change in other long-term operating liabilities. Long-term. And this is going to be change in excess cash, change in equity investments, change in other long-term non-operating liabilities. There we go. Okay, and that is going to get me my non-operating cash flow, which is going to be netted together to get my CFI. So, change in excess cash. My excess cash went from 265 to 370. I increased my excess cash by 105. I want you to understand the signs for this section more clearly. Cash flow available to investors. This is the cash on the table that I'm eventually going to be paid out. So everything on the top half of the statement is basically saying a positive number is adding to the cash on the table to pay out, cash flow available to pay out to investors, or taking away from that. Okay? If I make 654 free cash flow, does that add to my CFI or take away from my CFI? If I make 654 free cash flow, does that add to the cash on the table to pay out, or does it take money off of the table that I can't pay out? Using the metaphor. It adds. It adds to my CFI. So profits equal cash that I can pay out, adds to CFI. If I make non-operating profit of 29.4, does that add to the cash flow available to investors, or does it take away? If I make 29.4 of non-operating profit, does it add to the cash that I can pay out to investors or take away? Adds. Positive number. Okay. I have my main checking account is at Wells Fargo. My savings account is at Fidelity. I pay all of my bills and run my day-to-day out of Wells Fargo. I take money at Wells Fargo and I wire it to Fidelity to basically tuck it away for a rainy day and save for retirement. Okay, so I'm long-term investing that money. If I take money out of my checking account and send it to Fidelity, do I have more money to pay my bills in the short run or less money to pay my bills in the short run? Less. when I increase my excess cash balance, does it add to my CFI or take away from my CFI? Takes away, because it's like sending money to Fidelity. That's metaphorically how I want you to think about this. When a company is adding to its savings account, it's taking away money that could be paid to its investors. When a company raids its savings account, I'm out of money, I call Fidelity, hey, I need money that I had saved, wire it back to me. Now I have more money to pay my bills. A reduction in excess cash adds to your CFI. So I want you to understand, just as you're thinking about the signs here, particularly for excess cash, that's the way that excess cash is going to work. So in this case, excess cash went up by 105. What should this sign be? Positive or negative? Negative. This is money that is reducing my ability to give it to the shareholder in the short term. Change in equity investments. I bought more stakes in other businesses. Matter of fact, I paid an additional $345 to buy those stakes this year. Did that add to the cash that I could pay out to investors, or did that take away? Should this be positive or negative? It's a CFI. Equity investment, positive or negative 345? What should it be? I bought $345 million stake in another company. Does that add to the cash I can pay out or take away? Takes away. Minus 345. I'm telling you, this is the way that you have to think about these statements. There is no other way to do this. Right? You have to understand what the CFI is. You have to understand what the impact on the CFI is of the transaction. And that tells you whether you're adding or subtracting. If it's helping you generate cash, you're adding. If it's spending cash, you're taking away. That's the only way you're going to get these signs right, is you got to think it through conceptually. Final. My long-term liabilities went from, for non-operating, 200 to 500. Oh, sorry. 50 to 30. So basically, I paid the bill early. Does that add to my CFI or take away from the CFI? If I prepaid next month's rent, would you have less money to pay this month? Yes, so that's your negative to your CFI. Don't change the sign. Non-operating cash flows. CFI, operating cash flow plus non-operating cash flow. That is your CFI. I know many of you spent hours struggling on this. That's why I'm going through this and trying to be as granular as I can. But if you have questions, now is a good time to ask. Okay. Second side of the statement, just like TII. I have cash, 213. Where did I distribute it? Positive distributions. Second year, I lost 227. Where did I borrow it from? Negative inflows. That's what we're going to represent on the other side of the statement. So for debt and equity, distributions are positive, inflows are negative. So let's start out with the debt from the income statement. TII, we paid this much interest income. That was a distribution. Positive number. We then had change in debt, and I'll do this separately, short-term debt and change in long-term debt. So here's the point. You could have netted the debts out and then done the change, but I'm just going to do it more granularly. If our debt went from 80 to 240, we increased the debt by 160, is that a positive or a negative number on this side of the statement? Is it a distribution or is it an inflow? If the debt goes up by 160, distribution or inflow? Inflow. Therefore, negative number. Long-term debt. Same thing. Sorry. In fact, let's test this. What does negative 400 mean for long-term debt? What would we expect to see on the balance sheet? If I had a negative 400 on my CFI for long-term debt, what does that mean? Negative 400 to CFI, what does that mean? Looking for an answer. Negative 400, what does that mean? What should I expect to see with the debt in the balance sheet? Yeah.
Took one more debt.
So let's validate that. My debt went from 1,000 to 1,400. Exactly right. So what I'm saying is you should be able to work in both directions. See, right now we're building the CFI from the balance sheet, but this goes back to the next class. You're going to look at the CFI and you're going to tell me what happened to the balance sheet based on the CFI. So the other side of it, you have to start to understand too. If I see a negative, I am borrowing money. If I see a positive, I am paying out money. Right? Then I have my equity accounts. Let me just quickly remind myself of what they are. From minority interest down to treasury stock. All right, change in minority interest. Basically, it's just like debt. Change in preferred stock, change in common stock, these are just like debt. So essentially, I should be able to just copy and paste. Retained earnings. Don't do that because it's a change in the non-cash item. Treasury stock equals current year minus previous year. I told you the treasury stocks goes more negative because you're buying back more stock. If I bought back 245 million of stock, that is an outflow and therefore a positive number. Okay. The other outflows, I have all my fours. Okay. But am I missing something? What step did I skip? Cash flows income statement minus change in the balance sheet. I forgot the fours from my income statement. I forgot the dividends. So this is where troubleshooting will help you. If I add this up, I need to get to 213. I didn't get to 213. This is where labeling helps you. Oh, I see 4 fours. Well, 4 fours. Oh yeah, there's 2 more fours. I got 6 fours. I only got 4 accounted for. I forgot the dividends. All right. So again, why am I asking you to follow the labeling process? It helps you with troubleshooting. All right. First of all, it prevents you from making mistakes. Because if you don't label and you don't balance statements, then you made a mistake and you just forgot about all the cash flows associated with the dividends. That's bad. Okay? So I know it's a pain to do what we're doing, but doing what we're doing will make sure that you don't make mistakes like this, which are really easy to make. So back to the CFI, I have 2 more CFIs to do, which is the dividends from TFI, where are they? Preferred and common dividends, which are payouts. Which are positive numbers. C27 to C35. All right, so where did I make the mistake? That should be a positive number.
Didn't you break it into two pieces
Yes. So what I really need is what? I did after-tax interest income, but I should have done after-tax non-operating income, or put in non-operating income. Let's go back. After-tax interest expense, sorry, threes. So let me see where my mistake was. Back here. Let's see. Got my after-tax. Oh, I used the wrong one. After-tax interest expense. Why did I do interest income? It's been too many times today. After-tax interest expense. Boom. My threes. Put the wrong 3 in. That'll cause mistakes. What else did I do? Oh, what else did I do? 160, 400, minority interest. Did I do the minority interest? Forgot my minority interest. So, back to this. I did the minority interest on the balance sheet, but I didn't do the minority interest on the income statement. So this is the balance sheet. This is where, again, labeling would have helped us eventually figure this out. But I didn't do the minority interest on the income statement payment. That would have been and notice mysteriously that I now balance. So this is A, why we balance. Doing this 3 times a day, getting confused, make mistakes, moving quickly. Number 2, what do I need to fix? It's very quick to see, oh, I'm missing Legos. I forgot to do the income statement items. I only did the balance sheet items. These were the accounts that were missing. These are the sections I need to put it in. Now everything is back in balance. Okay, CFI. Questions about CFI? Now that we have a clean CFI, here's the most important thing, which is going to get to analytics. Here's how much cash I generated running my business. Here's how much cash I did doing other things. Here's how much total cash I made. Here's how I distributed the cash, or here's how I borrowed the cash. Okay, clean, balancing statements. Statement number 4 is probably easier, which was economic profit, or EP. Again, make it bigger, easier to see, equals years, copy paste. All right, first method was the spread method. So we take our NOPLAT, we take our invested capital, and if we know those numbers, I ask you to calculate a beginning of year ROIC, which is current year NOPLAT divided by last year's invested capital. Now, spread method says I compare that to my WACC to get a spread. I believe on the assignment I gave you a 6% WACC, which means I had a negative spread. So my economic profit, my beginning of year economic profit is the spread times the invested capital from last year. That is how much value I destroyed in each of the 2 years. Method number 2 is the dollar method. I take my NOPLAT and I subtract my capital charge. Same no plat. Capital charge is the WACC times last year's invested capital. So if I invested 3260 and you made 36%, I need to make 195.6 based on my beginning of year economic profit. I destroyed 34.6 in value. In this first year, 2018, did I generate cash flow? In 2018, did I create value? No, I did not. It's actually possible to create value and not have cash flow. It's also possible to not have cash flow and create value. Two separate statements. Okay, that's where we're going to get in the analytics. All right, but I want to give you a roadmap to where we're going. Now that we are done with the analytics, or done with the statements, we're ready to do the analytics. We have much clearer lines to do the analysis. So let me give you a preview. So I'll come back to TFI. I now have the ability to calculate an operating ROIC, which is if I take from my TII, my NOPLAT, and I divide from my TFI, my operating invested capital, I have an operating ROIC for the business. If I take my non-operating ROIC, if I take my non-operating income divided by my non-operating capital, I have a non-operating ROIC year by year. If I take my, I'll call this the Bloomberg ROIC. If I take my TII and I divide it by the TFI, equals TII divided by TFI, then I get the average ROIC of both. Now, it just so happens that they're pretty similar in this assignment, the operating ROIC and the non-operating ROIC. But the reason why we're going to do this is because we can see that the performance of the business overall is getting worse. The Bloomberg ROIC is getting worse. Then I can say, gee, is it the operating performance that's getting worse, or is the non-operating performance that's getting worse? All right, and then I'll have more granularity, because it could be that the business is getting worse because the operations are getting worse, or it could be the business is getting worse because all the things they're doing for non-operating activities are getting worse, which has nothing to do with the business itself. Or the business is doing poorly, but the non-operations is actually supporting it. So I want to be able to understand the two, and importantly, I want to forecast them differently. See, the one challenge with the way other people do this is they just use one number, the TII divided by the TFI, to forecast the whole business. And that the implicit assumption is the operating and non-operating are growing at the same rate. But that may not be the case. And long term, the reason I buy a business is because they're good at what they do. Okay? So if I buy a manufacturing company, I care about how well you do making products and services, your operating ROIC. But as if you're a manufacturing company and you start becoming your own venture capitalist and you go buy somebody else and start investing in their businesses, well, guess what? That's non-operating ROIC. It's not your core competency. I didn't buy you to go invest on my behalf in somebody else. I bought you because of what you do as a business. Now, eventually, if what you do is invest in somebody else, then that's an operating business as an investor. But that's a different business. That was a question you were starting to ask me before class. So, but the point is, when I look at a business long term, I want to see what their operating performance is. And I don't really care as much about their non-operating performance because that's not what you're supposed to be good at. Now, if your non-operating performance continues to overwhelm your operating performance, then I'm going to get concerned about what are you really doing as a business? Because if all this non-operating stuff is so big and consistent, then by definition it starts to become operating. Okay? Because that's the whole point of operating stuff is consistent. Non-operating shouldn't be as consistent, right? Because that's not supposed to be supporting what you do as a business. So nonetheless, we're going to split these two out. We're going to start looking at this more granularly, and eventually we're going to forecast this more granularly. So this is going to be the next step of where we're going to start to head to the analytics. And the nice thing is because we've separated the statements out into these sections, it'll be much clearer and much easier to do these analytics. Okay? So Wednesday, look for the next lecture note. In the next lecture note, we're going to get into the analysis that we're going to do because that's going to be your next assignment. I am going to put up a practice midterm. It's not going to be graded, but you might want to try doing another one of these exercises because when you do this midterm, you're going to have a little over an hour to do the entire thing. Okay? So you won't have an unlimited amount of time to do the conversion. And the conversion will be more challenging than this one because it will have more accounts. Okay? So practice will be helpful. So look for two things this week. Look for an alternative practice midterm. I'll give you an actual midterm from the past that you can play with. And secondly, get ready for the lecture on economic statement analysis, which is what we're going to do. Put up that lecture note as part of the reading for this week. Okay? See everybody next class. We're done.
So wouldn't you have ultimately undervalued Amazon if you were considering them as a merchandise company rather than their AWS services?
No,
If you
because
consider
AWS
that
is
non-operating,
AWS is
even
operating.
when they started?
Well, you'd have to understand that it was going to eventually be part of the business.
Okay.
Like if you thought it was non-operating, then yes.
So there's a little bit of an art rather than a science.
There is a little bit of art because you do have to figure out what's kind of the core business.
Okay.
But hopefully the company's doing that for you because when they report their statements, their operating profit should be based on their operating earnings and the businesses that are driving the operating earnings. And the non-operating stuff should be segregated. So hopefully the company is kind of differentiating for you.
Okay.
But because the company's differentiating, you're skeptical. Because what they can start to do is they can say, because this is what was happening with, there was a company called AOL a long time ago. And the way that America Online got started is they basically gave their service for free and they'd mail DVDs to people's homes. And so basically you get the DVD, you install it. I would call that marketing. They called it non-operating income and loss. And so it had nothing to do with their actual business. The mailing of product that enabled people to sign up for their online accounts. And they were exorbitantly misstating their earnings to investors. And people weren't paying attention for a couple of years because they basically said, all this marketing, we're not going to call it marketing. We're going to throw it over here in this other category. And they got in trouble for that.
Okay, cool. Awesome. Thanks.
So with the CFI, is it like would we lose points on that work if we didn't break down this category to calculate?
If you calculate, you're going to just check, do these two numbers match?
We'll look at it Wednesday.
Not the breakdown of categories for this.
Okay. Okay. All right.
Did you get the two numbers to match?
Yeah, I just did the change in non-operating capital from the TFI.
You could do it that way. Like I said, if you want to take shortcuts, I'm okay with the shortcuts. I went more granularly today because I want people to understand what's behind the shortcuts.
Okay.
But shortcuts are okay if you get it right.
Okay. Thank you.
And so then on the midterm that you were mentioning, are you going to do the labels for us, or is that going to be
for the
part
midterm?
of
I'm going to give you the labels.
Okay.
But later, when we get to Bloomberg, I will give you what I'm going to do is I'm going to give you a model that matches to the Bloomberg, a model that matches to Bloomberg.
Okay.
But every semester, Bloomberg is constantly adding new accounts that we've never run into before.
Yeah.
And you guys are going to have to figure out what those new accounts were and how to put them into the model
Well,
and where they go in the model.
sounds good.
And that's the fun part.
Thank you very much.
Sure.
Appreciate it.
October 23rd.